Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct. Coming up on today's show, we're talking life for Australian businesses post that RBA rate cut. I'm talking to Stephen Milch of the Suncorp Group. Stephen, thank you so much for taking the time to catch up with us again. Now we're into 2015.
Pleasure, thank you.
Okay, so how does private capital expenditure data on this Thursday highlight perhaps life post-RBA rate cut for Australian businesses?
Well, let's look at the data first. It was a very weak release, we have to say. It was for Q4, so a lot of the actual data predates the February rate cut from the RBA, but some of the expectations data is more recent. But the actual data showed that CapEx fell in the quarter by 2.2%. And the expectations were also very weak. It shows for the full year, 14-15, so the financial year we're in now, CapEx is likely to fall by about 9%. And perhaps more concerning for next financial year, 15-16, a further 12%. So it was a pretty weak report. And what does it show? It shows a couple of things. First of all, business confidence is very weak, and there's just not enough confidence out there for businesses to go out and spend on business investment, or at least increase their spending on business investment. But the other thing it shows is the transition that the RBA and the government is trying to achieve from mining to non-mining sectors. It's happening. So we had non-mining CapEx rise and mining CapEx fall, but it's not strong enough. So the lift in non-mining is not yet strong enough to offset the fall in mining, and that's something that that makes life difficult. You know, it makes life difficult for the RBA, job growth, and all those other areas of the economy. But they're the key messages from today's report.
You touched there on business confidence. Labour statistics, unemployment currently remains above at 6.4% and is likely to remain above 6% for some time. Again, is this sort of a key sign really of that lack of confidence that you just mentioned?
Yes, I guess there's a couple of points to make here. One is there's been a lot of volatility in the ABS labour market data. And they've admitted such, and they've looked into their processes, and they continue to do so. So we shouldn't place too much stock in any particular month's report. The trend, though, is clear, and the trend has been to rising unemployment. And again, it goes to that point I made earlier about weak business confidence. The two go hand in hand. As to the future, there are a couple of positive signs. One is we get series both from the government and the private sector on job advertisements. Now they're rising. So there are some signs there of businesses being prepared to hire. Should that flow through to employment growth, and our forecasts are that it probably will, then you've got the potential for a fall in the unemployment rate. I say the potential because the other missing link is what they call participation, how many people are looking for work. But let's say participation doesn't rise too much, and that employment growth that we talk about comes through, then it's possible that we may see unemployment back below 6% in the second half of this year. So it's not all doom and gloom, but there are a few things that have to go right and to fall into place for that to happen.
At the RBA's March meeting, the central bank is expected to show a readiness for further cuts, albeit not just yet. Are there concerns that further interest rate cuts could exacerbate that credit lending situation?
Yes, in a specific way. So credit growth, of course, is part of the way that monetary policy works. So we lower interest rates, and the hope is that we encourage people to borrow, whether it's to invest in the case of business investment, which we've discussed today, or whether it's for consumers to go out and buy a car or various other things. So that's a desired outcome of cutting rates. What's not desired is speculative activity, and one of the things we are seeing, or we have seen through 2014, is a lift in investor lending for property investment. And the risk there, and the RBA's concern to an extent, is that it drives a speculative housing bubble, and they don't want that. So was that concern sufficient to stop them cutting rates in February? No, it wasn't. And it may not be a reason for them not to go again. our forecast is they probably will go again, and as you say, it might be a couple of months away, 2 or 3 months away. So they're relying on other institutions, specifically APRA, and more recently the government has had something to say on the subject about curbing investment demand. So in a way, the RBA wants to set rates for the whole economy and leave specific macro-prudential measures, which is what we call them, to address speculative home lending.
Now, I also wanted to touch lastly on the Aussie dollar. There's been some debate, in fact, in recent days that the RBA is perhaps wrong in its repeated statement of overvaluation of the Aussie dollar. And in fact, the local currency may even be at its fair value now. Where do you sit on this debate?
Again, there's a number of competing influences. So we've seen the Aussie dollar fall with commodity prices, and historically there's been a very close link. So we've seen iron ore price fall, the various other commodities that Australian exports have all fallen, and traditionally the Aussie dollar has fallen with that. So it's not surprising. The other key influence that has worked against the Aussie is interest rate differentials, so our gap over United States rates. That's narrowed, so again the attraction for the Australian dollar falls and the currency falls. There are some good things though, and which I think may support the Aussie going forward. The consensus is that the Aussie goes weaker. But we are AAA rated, and there's not many economies out there that are still genuine AAA credit rated economies. We have strongly growing exports, so even though commodity prices have come off, we're digging a lot of stuff out of the ground and we're selling it. So our trade deficit has come off, and that's normally good for currencies as well. And the third aspect that still is quite positive is, notwithstanding some of the doom and gloom that we've discussed today, our GDP growth is still quite reasonable. It's between 2 and 3%. Europe would love that. Japan would love that. So we may, in fact, see a little bit of a bounce in the Aussie, and I wouldn't be surprised if it does go back over that 80-cent mark in the next few months.
Stephen, always a pleasure to receive your thoughts. Many thanks for your time today.
Pleasure. Thank you, Natalie.
That is all we've got time for right now, but do stay tuned as I'll be back with plenty more exclusive interviews right here from Sydney, Australia. For now though, it's goodbye.